So, as some of you may or may not be aware, Nvidia has a pretty large venture capital division that invests in other companies and stocks, especially smaller tech companies that need help building up larger operations over time. With Nvidia's help and expertise in areas like artificial intelligence, robotics, gaming, and other similar technologies. In return, Nvidia gets stock in these companies, partners with them, and gradually benefits from their success. Well, this past year, Nvidia's investments got so large that they are now required to submit a 13F report to the SEC every quarter, which means we can see exactly how much money they have invested in these specific companies. Since they just reported again about a week ago, we will take a look at these stocks ourselves, and I'll give you my opinion on each in today's video. Now, there are 6 stocks in total that Nvidia owns, and ever since they started having to report these figures, Nvidia's stock portfolio has nearly doubled in size just in the past year alone, reaching well over $400 million last quarter. So, running through these stocks here from smallest to largest position in that portfolio, we have stock number 1, NanoX Imaging, ticker symbol NNOX. This is very small for them, accounting for only 0.1% of the portfolio, but worth over $360,000. This will probably be the least interesting of the bunch because of how small it is. However, the company is developing unique and impressive imaging technology that uses artificial intelligence for greater precision and detail in medical imaging. I feel this is extremely important for the future of healthcare. Having a non-invasive way to see exactly what's wrong inside the body and how to fix these issues will be huge for healthcare moving forward. NanoX also deploys simplified X-ray beds and lightweight 3D tomosynthesis imaging systems. These systems, they claim, can scale up much faster and easier around the world without compromising on high detail and efficiency. This is alongside their NanoX Cloud platform, which uses AI to enhance and improve diagnostics while expanding its reach further because of its cloud-based capabilities. As I said, it's all pretty fascinating work, and Nvidia can help NanoX scale up and expand as demand rises. NanoX can help Nvidia get deeper into the healthcare tech and AI field. Of course, NanoX is still in the very early stages of commercializing its products, with only a small presence in just a handful of countries. They are still working through various regulatory hurdles to bring more of their products to market. This has resulted in deep losses that exceed their current sales revenue. The stock, at least, has fallen greatly from its peak, down almost 80% since its IPO a few years ago, and even more from the brief highs it reached shortly after before crashing back down. It's now almost considered a penny stock, which may entice some speculative, higher risk-oriented investors to jump in. Considering the high revenue growth of over 30% this year and another 200% plus expected next year, likely due to the recent FDA approval of their NanoX ARC platform, this could help them expand further in America. However, the stock is still a bit too speculative for my taste. The price-to-sales ratio remains extremely high at over 30, so they will really need to post consistently high growth numbers to justify the valuation from a sales perspective alone. I guess that Nvidia wants to take a small bet on this technology, see how it evolves, and determine how it can benefit or help this company grow, potentially reaping long-term benefits. However, as an outside investor, I will pass on this one for now. Stock number 2, SoundHound AI, ticker symbol SON. Many people consider this a much lower risk and less speculative AI stock, and I certainly agree with that. Nvidia owns about $8 million worth of SoundHound AI, which accounts for 2% of its overall portfolio. SoundHound initially became popular through its smartphone app, which helps users detect songs playing in the background and provides all the information about them. More recently, they have expanded their sound detection technology and started integrating artificial intelligence into it, making it much more powerful. The voice AI can now recognize and respond to different voice prompts and speech, even in different languages. It is being used more heavily recently in many speaker systems, such as fast food drive-thrus. It's also used for phone and in-store ordering, handling customer service, and assisting with in-store operations alongside staff. A few notable food customers include White Castle, Jersey Mike's, and Krispy Kreme. But it doesn't stop there. SoundHound also has a growing automotive AI assistant platform that is not only being used by Mercedes, Honda, Kia, and more, but they're also partnered with Square, Qualcomm, and countless other companies that use their tech in various ways. Nvidia is already benefiting from its closer relationship with SoundHound, as SoundHound's AI platform and technology are being integrated into Nvidia's Drive platform. This platform is often used for autonomous driving and smart car systems. SoundHound is even integrating generative AI, similar to those found in ChatGPT or Google's Gemini, into its technology, which they continues to expand upon. The result has been soaring financials for the company, with total sales growing nearly 50% annually. The next 2 years are expected to accelerate further, with growth approaching nearly 100%, which is impressive. Unfortunately, though, this is another unprofitable company at the moment, with deep losses on the bottom line and a rich valuation after the stock price increase. The price-to-sales ratio is almost 30. However, I completely understand why others are taking a chance on it, and I think they'll have a bright future with rising demand for voice AI, especially if Nvidia continues to support them. Up next, though, is a newer pickup for Nvidia. This robotics company barely IPO'd this year, making it very interesting. The company is Serve Robotics, ticker symbol SRV, and Nvidia owns over $30 million, making up about 7% of its portfolio. As the name implies, Serve develops and operates electric robots for the service industry, starting with food delivery and planning to expand into other areas in the future. Because of this, even Uber has decided to invest and partner with Serve, using their zero-emission, AI-powered autonomous robots to deliver food for Uber Eats. The company is also partnering with 7-Eleven and other brands, but Uber Eats is the most significant partner. Uber has already ordered a couple of thousand smaller-sized robots that can autonomously deliver food around cities. These robots are already operating in Los Angeles, with about 100 currently in service, and they have plans to expand across the country throughout the coming year. As you might expect, financials have been pretty weak, with very little revenue and millions of dollars in losses. However, this is expected to improve dramatically in the coming years, thanks to new orders and the large market size, which they estimate to be worth $450 billion by 2030. However, Serve only generates thousands in annual revenue, as seen in last year's results. The real issue is valuation. Serve IPO'd earlier this year, technically around $4 per share, but the stock quickly soared to almost $18, probably when the market found out Nvidia was investing in them. However, just a month later, it crashed down to around $8 per share, which continues to hover today. Comparing this to their revenue, sales are expected to soar in the coming years. For example, by 2026, revenue is expected to grow nearly 300% to over $62 million. That's excellent growth. However, when we calculate the price-to-sales (PES) ratio, we get over 1,900 for last year, 181 for this year, 24 for next year, and still about 6 by 2026. These metrics are improving dramatically, but we're still talking about at least a few years until we see these valuations level out. This also assumes everything goes perfectly for the company and it hits all its targets. Even then, Serve would still not be profitable by 2026, and I wouldn't expect profitability for several more years after that. Number 4 is actually one that I will encourage everyone to buy, but I just haven't gotten around to it yet. Maybe I will soon, because that stock is Recursion Pharmaceuticals, ticker symbol RXRX, which Nvidia owns over $50 million worth, accounting for 12% of the portfolio. Recursion is often thought of as one of Cathie Wood's favorite biotech companies. It's one of her largest holdings, but I think their partnership with Nvidia is much more important. Recursion's platform uses AI to discover new drugs at lower costs and with higher efficiency, reducing the time it takes to research, identify, and develop new treatments. While their own programs are still being tested, the company supplements its efforts by licensing the platform to other giants like Roche, Bayer, and Merck. Sticking with Nvidia for a moment, they've helped Recursion build what is considered the most powerful biotech supercomputer in the world. This supercomputer analyzes over 50 petabytes of health-related data, which Recursion gained through another partnership with Tempus. All of that alone makes this stock super interesting, as it represents one of the largest and most robust healthcare AI research platforms for the future. The problem, however, is that just like the rest of these, Recursion is another unprofitable company with a rich valuation. Their losses far eclipse their revenue, and the price-to-sales ratio is sky-high at over 23. However, with the stock now trading near its lowest levels ever, and considering that all it would take is 1 or 2 breakout treatments to send their financials soaring and reduce the valuation, Taking a small chance on this one would not be bad. It's a very speculative stock to bet on long term, but I think they have a ton of potential, and it's one actually should be on your radar. Alright, guys, we're now down to the final two stocks. These are the two largest holdings. Coming in at number 5, we have a brand new pickup for Nvidia, which has already become their second largest holding, Applied Digital, ticker symbol APLD. Nvidia now owns $64 million worth, representing about 15% of the overall portfolio. If you've never heard of them, the biggest thing Applied Digital does is build and host large next-generation data centers for high-performance computing, cloud services, and even blockchain and cryptocurrency operations. In fact, cryptocurrency hosting is currently the largest part of their business. Considering how Nvidia and AMD chips are often used for crypto mining, it makes sense that Nvidia would want to invest heavily in this area. Applied Digital itself uses tons of Nvidia GPUs in its own data centers, so the match makes perfect sense all around. As we all know, there has been a significant rise in demand for AI and cryptocurrencies, and Applied hosts many of the companies and operations driving this demand. This is evident in the rise of hyperscale data centers being built worldwide and the recent skyrocketing price of Bitcoin, which has once again reached new highs. The result has been strong growth for Applied Digital, with their sales nearly tripling last year. However, here's where the bad news starts. Analysts expect that growth to dwindle over time, falling to 65% next year, 55% the year after, and only 20% in subsequent years. Even then, they are still not expected to generate positive earnings per share, EPS, meaning we have to value this stock again based on sales. After more than doubling in the past year, Applied's price-to-sales ratio is over 6. Finally, coming in as the largest holding of all, at stock number 6, we have what many consider to be a much lower risk investment, another chip-related company, ARM Holdings, ticker symbol ARM. Nvidia currently holds over $280 million of ARM, representing a whopping 65% of the entire portfolio. When it comes to the business, ARM is responsible for designing the most popular chip architecture in the world, which many other chips are built on. This includes, by the way, around 99% of all smartphone processors. ARM collects royalties and licensing fees for these chips. The reason why ARM's architecture is so popular is that it's simpler and more battery efficient compared to x86 architecture. As a result, ARM chips are usually used for smaller devices rather than massive data centers. However, there is still huge potential for ARM in not just smaller components but larger systems as well.